If you walk into a grocery store and intentionally fill your cart with like deaded cans and, bruised apples or expired milk just because they've been tossed in the bargain bin, people will look at you like you've completely lost your mind.
Oh, yeah. I mean, to think you were crazy. It defies basic common sense in almost every area of life. You want quality.
Right. I mean, why would you want damaged goods?
Hmm.
But in the stock market, that's precisely what classic financial wisdom has, well, conditioned us to do. We are constantly told to buy low.
Right. The old buy low, sell high mantra.
Exactly. So we scroll through our brokerage apps, hunting for these cheap, beaten-down stocks, absolutely convinced we're snagging this incredible bargain. But what is that entire bargain hunting mindset is actually the absolute fastest way to completely decimate your portfolio?
Yeah, it's what we call the trap of the value illusion.
Mhm.
We see a stock hitting a 52-week low, and we just, assume it's on discount.
Like it's on sale.
Exactly, like a clearance rack. But when you look at the raw mathematics of the market, I mean, a stock plumbing new lows is usually just a giant flashing red flag indicating severe fundamental deterioration.
It's cheap for a reason.
Eh?
So today's deep dive is about flipping that deeply ingrained dogma entirely upside down. We are handing you a complete operational blueprint for finding monster growth stocks before they surge.
It's such a powerful framework.
It really is. We are unpacking William O'Neill's legendary investing classic, How to Make Money in Stocks, and his battle-tested Can Slim system. And, this isn't about throwing darts at a board or listening to some guy shouting on financial television.
No, far from it. O'Neill's approach is so compelling because he didn't just sit in an ivory tower and theorize about how markets should work. He actually built a massive historical database.
Like going way back, right?
Oh, decades. He spent decades painstakingly studying the single greatest winning stocks in history, going all the way back to the late 1800s, right through the early 20th century industrial leaders, all the way up to modern tech giants.
He was basically looking for the genetic code of a superstock.
Precisely. He analyzed what all these massive multi-100% winners had in common before they launched into their historic price runs. He wanted the repeatable characteristics, footprints.
Which makes sense.
Yeah, and he developed a dual-pillar philosophy. It combines fundamental analysis, which dictates exactly what to buy, with technical analysis, which tells you the precise second of when to buy it.
Okay, let's unpack this. Because if you are looking at your portfolio right now and wondering why your stocks are just, moving sideways or bleeding out, it usually comes down to the fundamental engine.
The underlying business.
Right. So let's start with the spark that actually makes a stock price explode. It all begins with massive current earnings, which is the C in Can Slim. O'Neill found that the biggest winners didn't just have a good quarter.
They had explosive quarterly earnings growth.
Explosive. We're talking a minimum of 18 to 25% year over year.
But I gotta ask, why the year-over-year distinction? Why not just look at the last 3 months? Because of seasonal noise. I mean, if you're analyzing a major retailer, you can't compare their quiet January slump to the massive December holiday quarter. That's just the natural business cycle.
Oh, right, because everybody buys gifts in December.
Exactly. So by comparing the current quarter to the exact same quarter 1 year ago, you completely strip out the seasonality. You get a true, undeniable measure of growth acceleration.
That makes a lot of sense.
And frankly, while 18 to 25% is O'Neill's absolute floor, the true elite market leaders, the ones that go on to define a generation, they often show 50, 100, or even several 100% earnings acceleration.
Wow. But, anyone who has followed corporate scandals knows that management teams can play games with their accounting.
Oh, all the time.
They slash research budgets or use one-time tax loopholes to artificially inflate that earnings number for a quarter or two. So how do you actually know the growth is real?
That is the crucial cross-check. You cannot rely on earnings alone. O'Neill insists you must verify those earnings with top-line sales growth of at least 25%.
Because you can't fake sales.
Exactly. You can fake earnings by cutting costs for a while, firing people, whatever, but you cannot fake revenue coming in the door. If revenues are surging at 25% alongside explosive earnings, that tells you there is ravenous, genuine demand for whatever this company is selling.
Okay, so we have our massive quarterly spark. But a spark isn't enough to keep a multi-year rally burning, right? We need a sustainable fire, which means zooming out from the current quarter and looking at the company's annual track record, the A in Can Slim.
Right, the annual earnings.
Yeah. O'Neill wants to see a 3 to 5 year history of 25% or more annual compounding growth.
Because this proves the company isn't just a flash in the pan. A one-hit wonder product might give you a great quarter, but sustained annual growth proves they have a highly scalable, sustainable business model.
It's real longevity.
Yeah, and alongside that growth, O'Neill found another absolute necessity in the historical data, which is a return on equity, or ROE, of at least 17%.
Okay, let's pause there, because ROE is one of those terms financial analysts throw around that just makes people's eyes glaze over.
Yeah.
What does a 17% ROE actually tell me about the company I'm buying?
Think of ROE as a measurement of management's raw capital efficiency. It basically measures how effectively the leadership team is using the actual money investors have given them to generate profit.
Like how good they are at spending their budget.
Exactly. If a company has a 5% ROE, they are incredibly inefficient. They are practically burning cash just to keep the lights on. But a 17% or higher ROE, that proves the company is a compounding machine.
They're actually putting your money to work.
Right. They are taking your investment, deploying it brilliantly, and generating massive returns without having to, borrow heavily and pile on dangerous debt just to fake their growth.
Okay, so here's where it gets really interesting. You have this incredibly efficient company with explosive earnings. But to push a stock to completely unprecedented heights, you usually need a catalyst.
Something new.
All right, the N in Can Slim. That could be a revolutionary new product, aggressive new corporate management, or a major shift in the industry, like a supply shortage or government regulations changing.
Yeah, any sort of systemic shift.
But there is another new factor O'Neill demands, and it's easily the most controversial part of his entire system. New price highs.
Oh, man. It is the single hardest concept for retail investors to accept.
I can see why. I mean, you're telling me I should buy a stock right as it hits an all-time 52-week high. That feels so completely counterintuitive. Isn't that exactly like paying full retail price for a flat-screen TV when everyone else in the store is just, waiting for the Black Friday blowout sale?
It feels wrong because, as humans, our psychology naturally gravitates toward perceived bargains. We want a deal.
You want to feel like we won.
Exactly. But the stock market is not a retail store. Cheap stocks are cheap for a very specific reason. Declining demand, terrible management, intense new competition, or maybe looming litigation.
It's the dented cans again.
The dented cans just get more dented. The historical data overwhelmingly shows that stocks sitting at 52-week lows tend to just keep dropping to new lows.
Wow. Okay, but what about the new highs?
Let's look at the psychology of a stock hitting a new all-time high. Imagine you bought a stock at $50 and it immediately crashed to $30. You are trapped. You are underwater. Every single day you look at your portfolio, you feel the pain of that loss. What are you waiting for?
I'm just praying it gets back to 50 so I can sell it, break even, and never look at it again.
Yes. And there are thousands of investors just like you in that stock. That creates what we call overhead supply. Every time the stock tries to rally back toward 50, an army of trapped, exhausted investors sells to break even.
Which just crushes the rally.
Right. But when a stock breaks out to a brand new all-time high, by definition, there is absolutely no one trapped at a loss. Every single person who owns the stock has a profit.
Because it's never been this high before.
Exactly. There is no overhead supply pushing down on the price. It's clean air. Statistically, the stocks breaking into new high territory are the ones with the highest probability of doubling or tripling.
Okay, that makes total sense when you frame it around the psychology of trapped buyers.
Mm-hmm.
So we've found a company with explosive earnings, incredibly efficient management, a new catalyst, and it's breaking into clean air at a new high. But who is actually buying enough shares to push a multi-billion-dollar company's stock price up?
It's not the retail guys.
Right. You and I buying 100 shares on our phones isn't going to move the needle at all. This requires massive market mechanics.
It requires the whales,
Good.
the massive institutional funds. And to understand how they operate, you have to understand the mechanics of share supply, the S in Can Slim.
Okay, let's unpack this. O'Neill specifically points out that small to mid-cap stocks with a low floating share supply are the prime candidates. And just to be clear for everyone, float refers to the actual number of shares freely available to trade on the open market, right?
Right, discounting the shares locked up by insiders or corporate management.
Okay. Think of it like trying to move a speedboat versus a massive cruise ship. The speedboat has a low share supply. When you rev the engine, it skips across the water instantly.
Yeah, it just flies.
But the cruise ship has billions of shares outstanding. It takes a monumental amount of energy just to turn it a few degrees.
And in the market, that engine revving is trading volume. Volume is the undeniable footprint of big institutional money.
Because they can't hide it.
Exactly. A multi-billion-dollar pension fund cannot hide their buying. When a stock is resting or consolidating its prior gains, you want to see the daily trading volume dry up completely. That tells you the heavy selling pressure is completely exhausted. No one wants to sell anymore.
But when it finally breaks out to that new high,
You need to see a violent surge in daily volume, ideally 40 to 100% above its average daily trading volume.
wow, that's huge.
It has to be huge. That massive, towering volume spike is the mathematical confirmation that mutual funds and hedge funds are aggressively accumulating the stock. They are stepping in and buying millions of shares, and that is what launches the price.
Which means we are essentially just tracking and following the smart money. And that covers the L and the I in the system. O'Neill is adamant that you only want to buy the undisputed leader in a specific sector. You don't buy the sympathy play or the laggard hoping it catches up.
No, never.
He uses a metric called relative price strength, or RS. You only want stocks with an RS rating of 80 or higher, which simply means this specific stock's price action is currently outperforming 80% of all other stocks in the entire market.
It's survival of the fittest. You want the absolute apex predator of the sector, and that leadership directly correlates with institutional sponsorship, the I in Can Slim. You need those heavy-hitting mutual funds backing the stock.
And you want to look at the quarterly reports to ensure the number of funds owning the stock is steadily increasing over time, right?
Yes, increasing is key.
But I know O'Neill warns of a massive trap here. It's possible to have too much of a good thing. Over-sponsorship.
Yeah, and this is a critical nuance. If a stock becomes so universally beloved that every single major mutual fund already owns a massive established position, the trade becomes dangerously crowded.
There's nobody left to buy it.
Exactly. The reality is there is simply no big money left to step in and drive the price higher. Everyone who could buy it already has. And worse, if the company misses an earnings estimate and all those fund managers decide to take profits at the exact same time,
Oh man, the rush for the exit doors will completely crash the stock price.
it's a bloodbath. You are looking for a stock with a growing, healthy base of high-quality sponsors who are just starting to discover the company's superior growth.
Okay, so let's say I found this absolute unicorn. The earnings are exploding, the float is low, volume is surging, and the smartest mutual funds are just starting to accumulate. Is that it? Do I just click buy, sit back, and wait to get rich?
You would think so, but there is a brutal overriding truth to the stock market that will completely ruin that perfect setup. The general market trend. The M in Can Slim. 3 out of 4 stocks follow the primary direction of the general market. That is a sobering statistic.
It really is.
You could have the most perfect company in the world, but if the broader market like the S&P 500 or the NASDAQ is crashing into a bear market, your perfect stock is almost certainly going to fail. You just cannot fight the macroeconomic tide.
No, it's like swimming upstream in a hurricane.
Right.
Yeah.
But how do we actually know what the market direction is without listening to, TV pundits constantly screaming about interest rates or inflation fears?
You ignore the pundits entirely. You listen only to the daily price and volume action of the major indices. O'Neill identified specific signals to spot market tops and market bottoms.
Okay.
To spot a market top where the whales are starting to quietly cash out, you look for what he calls a distribution day.
What exactly does that look like on a chart, like mathematically?
A distribution day occurs when a major index, like the NASDAQ, closes down in price by at least 0.2%, and crucially, the total trading volume for that day is higher than the previous day. Wait, so the market lost ground and the volume was heavier?
Exactly.
That means the big money is actively selling into the weakness.
Precisely. They are unloading. Now, one day doesn't mean the sky is falling. But if you see 4 to 6 of these high-volume distribution days clustered together within a tight 4 to 5 week window, the bull market is topping out.
The institutions are heading for the exits.
Yeah. That is your undeniable mathematical signal to stop buying new stocks, tighten your stop losses, and start locking in your profits.
Okay, so that's how we protect ourselves at the top. But what about the reverse? When the market has been bleeding out for months, everyone is panicked and stocks are super cheap. How do you know when it's actually safe to dip your toe back in without trying to catch a falling knife?
You sit on your hands and wait for a follow-through day. O'Neill's research proved that no major new bull market in history has ever started without this specific phenomenon.
I really want to break this down carefully because the timing here is incredibly specific, and I know a lot of people get this wrong.
The process starts when the market has been trending down, but finally manages to close positive for a single day. We call that day one a rally attempt.
But we don't buy on day one.
Absolutely not. Day one is usually just short sellers covering their positions, locking in their profits from the crash. It's not real buying.
Right, it's just a bounce.
Yeah. On days 2 and 3, the market might chop around, but it must hold above the absolute low of day one. If it breaks below that day one low, the rally attempt is dead. You reset the clock to 0 and wait.
But let's say it doesn't break. The market holds that low. The panic seems to be subsiding.
If it holds, you look to day 4, or any day after that. You are waiting for the index to suddenly explode higher, usually surging 1.5 to 2% or more for the day.
Huge move.
But the price jump isn't enough. The trading volume must be significantly higher than the previous day. That explosive high-volume surge is the follow-through day.
A green light.
Yes. It is the definitive footprint of institutional money aggressively stepping back into the market to start a new bull phase. That is when you get off the sidelines.
Okay, this brings everything together. The broad market just had a follow-through day, so the wind is at our backs. We found a canned slim stock with explosive fundamentals, and the institutions are accumulating it. Now, we reach the final hurdle.
The precise timing.
Exactly. Mastering the technical chart patterns to know the exact moment to hit buy. And O'Neill is legendary for identifying these structural setups, most notably the cup with handle.
It is his signature discovery. If you look at a daily or weekly price chart, it literally looks like the profile of an everyday teacup.
But it's not just a random doodle on a chart, right?
Yeah.
There's a very strict anatomy to it.
Oh, very strict.
First, the stock must have a prior uptrend of at least 30%. It has to prove it's a winner first. Then the market corrects, and the stock pulls back, forming a wide U-shape. The depth of that bowl is usually a 12 to 35% decline from the peak, and it takes anywhere from 7 to 65 weeks to form. But I really want to push back on this shape. Why a U-shape? Why not a sharp, aggressive V-shape where the stock crashes and immediately spikes back up? I mean, a V-shape seems so much more powerful.
It looks powerful, but a V-shape is actually highly prone to failure because it hasn't done the necessary psychological work.
Psychological work.
Yeah. Think about what a wide, rounded U-shape actually does to an investor. It slowly, agonizingly grinds out the weak, panicked retail holders. It takes weeks, sometimes months. The stock drifts lower, chops around at the bottom, does absolutely nothing.
Just boring them to death.
Exactly. The retail investors get bored, they get tired, they get scared by a bad news headline, and they finally capitulate and sell. And who is quietly, patiently absorbing all those dump shares at the bottom of the U?
The big institutional funds. They're using the boredom to build a massive position without spiking the price.
Precisely. So by the time the stock finally starts climbing back up the right side of the cup, all the weak, fearful hands are gone. The shareholder base is now incredibly strong.
And then comes the handle. The stock reaches the top right of the cup, nears its old all-time high, and then it pauses. It pulls back slightly, usually dropping 8 to 12%, forming the handle in the upper half of the structure.
And during this pullback, the trading volume should be extremely quiet.
It's just drifting.
Yeah, it's shaking out the last few weak holders.
The exact buy point, the moment you finally pull the trigger, is one single tick above the highest point of that handle. And when it crosses that line, you want to see that massive 40+% surge in volume.
That volume through the handle is your ultimate mathematical confirmation that the consolidation is over and the next massive run has begun.
O'Neill also outlines a few other key patterns too, right?
Yeah.
There's the flat base, which is essentially just a shallow 10 to 15% sideways pause for a few weeks after a stock has already run up 20%. It's catching its breath.
Yeah, just resting.
And then there's the double bottom, which looks like a giant letter W on the chart.
The double bottom is fascinating because it relies on a very specific structural rule. The second leg of the W must drop slightly lower and undercut the lowest price point of the first leg.
Wait, it has to drop below the prior low. Isn't that a breakdown?
It is a deliberate, manufactured shakeout. It creates a false breakdown on the chart.
Oh, I see.
Think about the average retail investor using technical analysis. They see the first low of the W, and they put their protective stop-loss order right below it. When the stock purposely drops below that level on the second leg, it triggers all those automated sell orders.
It terrifies the absolute last remaining fearful investors and flushes them completely out of the stock.
Yes. And once that final weak supply is absorbed by the institutions, they launch the stock higher. Your precise buy point is the middle peak of the W.
It's absolutely brilliant how these chart patterns aren't just, squiggly lines. They are real-time visual maps of human fear, exhaustion, and greed.
They really are.
But that brings us to the final and undoubtedly most critical part of this entire system, self-preservation. Because, let's be real, you can find the perfect canned slim stock, verify the follow-through day, perfectly time the breakout of a cup with handle.
And the stock will still crash in your face sometimes.
Right. You are going to be wrong. So how do you survive your inevitable mistakes?
You survive by implementing an absolute non-negotiable rule that you must swear by before you ever buy a single share. You cut every single loss at a maximum 7 to 8% below your purchase price, no exceptions, no waiting to see if it bounces back.
Wait, a strict 7%. I have to ask, in today's modern market, where an algorithmic trading glitch can swing a stock 5% before lunch, won't a strict 7% rule just get me chopped to pieces? I'm getting stopped out of everything constantly.
It feels restrictive, but it is the only mathematical way to survive. Think of it like buying auto insurance. You don't buy car insurance hoping to crash your car on the highway.
No, obviously not.
You buy it so that if a massive crash happens, the hospital bills don't literally bankrupt your family. A 7% loss is just your insurance premium to stay in the game and avoid a catastrophic drawdown. It protects your mental capital as much as your financial capital.
And when you look at the raw math of recovering from a loss, it becomes terrifyingly clear why you have to cut it early.
The cold math of recovery is brutal. If you respect the rule and lose 8% on a trade, you only need a roughly 9% gain on your next trade to get your account back to completely whole. A 9% gain is very common in a bull market.
Super doable.
But as the loss gets bigger, the math turns against you exponentially.
Right. Because if you arrogantly hold on and write a stock down 50%, you don't need a 50% gain to recover.
Yeah.
If you have $10,000 and it drops 50%, you only have $5,000 left. To get back to $10,000, you need a massive 100% gain.
You have to literally double your money just to get back to zero.
To recover from one single stubborn mistake. So yeah, cut it early.
Conversely, you need equally strict rules for taking profits on the upside so you don't give your gains back. O'Neill's baseline rule is to sell and lock in your profits when you have a 20 to 25% gain.
Okay, so a 20% win against a maximum 7% loss.
Exactly. Think about the mathematical ratio there. That creates a highly profitable 3-to-1 risk-reward system. You could literally be wrong on half of your stock picks, and with a 3-to-1 ratio, your portfolio will still grow significantly.
But there is one massive, crucial exception to that 20% profit-taking rule, isn't there? It's called the 8-week hold rule. If you buy a stock perfectly on a breakout, and the demand is so unbelievably powerful that it hits that 20% profit margin in less than 3 weeks.
Do not sell it.
Right, hold on to it.
Do not touch it. That velocity moving that far, that fast, indicates extraordinary institutional momentum. You haven't just found a good trade, you have likely caught a generational market leader. O'Neill's rule states you are required to hold that specific stock for at least 8 full weeks from the initial breakout date. You must give that massive trend room to develop, allowing you to capture those life-changing, multi-100% moves.
But eventually, even the greatest leaders top out. How do we know when that months-long or years-long trend is finally over? How do we spot the climax top so we can protect those huge gains?
You look for the signs of final exhaustion. Ironically, it usually looks like incredible strength.
This is just going vertical.
Yeah, the largest single-day price gain in the entire multi-month run is often a sign of late-stage panic buying by retail investors who just can't stand missing out anymore.
Ah, the FOMO phase.
Exactly. Or you might see massive, record-breaking daily volume, but the price closes flat for the day. That is heavy distribution. The institutions are quietly using the retail excitement to dump massive blocks of shares.
Very sneaky.
And finally, if the stock decisively breaks down below its 50-day moving average, that smoothed out line tracking its average price over the last 10 weeks, and it does so on heavy volume, the primary uptrend is officially broken. The party is over. Time to leave.
Which brings up the classic amateur mistakes we see over and over that you have to avoid. Never buy cheap, sub-$10 junk stocks just because they feel like a bargain. Never, ever average down on a losing position by buying more shares as it drops.
Averaging down is how amateurs turn small, manageable mistakes into account-destroying disasters.
Oh, totally.
You are throwing good money after bad. You have to remove your ego and mechanically follow the system. And stop listening to TV pundits, internet gurus, and hot tips from your brother-in-law. Rely purely on the objective fundamental data and the price action on the charts.
So what does this all mean for you as an investor? The absolute beauty of O'Neill's system is that it completely removes your fragile human emotions from the equation. You demand explosive fundamental earnings, you verify massive institutional buying volume, you execute only on proven technical breakouts out of specific chart patterns, and you ruthlessly mechanically cut your losses at 7 or 8%.
It replaces hope, fear, and guessing with probability, history, and discipline.
Yeah.
But, this raises an incredibly important question for you to mull over as we wrap up.
Oh, what's that?
Well, O'Neill built this incredible system over decades, analyzing the psychology of human fear and greed, which historically prints these exact chart patterns, right? The grinding U-shapes, the terrifying undercut Ws.
Right.
But today, we live in an era increasingly dominated by artificial intelligence and algorithmic high-frequency machine trading. So the question is, do these human psychological footprints still dictate the market's timing?
Oh, that's interesting.
Or are the deep learning algorithms simply learning to paint the tape, purposely creating a perfect cup with handle to prey on retail investors who are meticulously searching for it, only to trap them in a false breakout?
Wow. That is a fantastic point to end on. Are the machines front-running the very psychological patterns we just spent this whole deep dive learning? Are they hunting the canned slim traders?
It's definitely something to think about.
It is definitely something you need to keep in mind the next time you look at a perfectly formed stock chart.
Well, thank you for joining us on this deep dive into the mechanics of super stocks. Remember to always keep your losses ruthlessly small, let those proven winners run, and whatever you do, stop putting the dented cans in your shopping cart. See you next time.